Compound interest investing in stocks. How does it work and how can you earn from it? Before we get into this video, should probably make a little disclaimer, particularly about how stocks don't technically earn interest. They earn dividends and capital gains, and I'll cover that in a little more detail in my next video. But it's really a matter of semantics. The principle remains the same. The return stocks earn are expressed as an interest rate, so you think of it that way. But anyhow, here's a quick summary of what I'll cover, and particularly how compounding can help investments grow at an ever-increasing rate, and how assets and liabilities can both compound. The more frequently that the asset compounds, the greater the return, even at the same interest rate. And, all of this we'll get into with a couple examples in a spreadsheet to show how it works. And speaking of the spreadsheet, that'll be available to download if you want to tinker around with it to learn a little more about the subject. You can look for the video and the notes on investssomemoney.com, along with a bunch of other blog posts and videos and notes, and link to the page on investssomemoney.com that has the spreadsheet. So in the end, also cover a couple of questions that I pulled off of Quora related to the subject at hand, and hopefully those will address any questions you might have, or if it doesn't, then you can leave those down in the comments. So let's get into it here. Start basic, start fundamental. What is compounding? Okay, it is capital gains, interest, or dividends, returns in essence, that are reinvested to earn a higher return over time. Okay, how does that happen? Well, the earnings generated from the initial investment, okay, those returns are added to earnings from previous periods. So you're earning interest on interest in essence, returns on returns. Okay, the more earnings that you get and reinvest back into the asset, the more earnings you're going to get for a given period. Okay, so it snowballs. All right. The returns then on your initial investment are going to magnify over time. Every year that it compounds, the amount you make is going to be more, more, more. Here's an example of what compounding is. We've got a 10% interest rate for a $10,000 investment. That turns into $25,937 over 10 years. Okay. What I did, we'll look at the actual spreadsheet here. Let's break out change that back to what it was, 10,000, 10,000. The interest for every year. Okay, so $10,000, 10% is going to earn, this original investment's going to earn $1,000 per year. Okay, $1,000 is 10% of $10,000. Okay, so we broke that out by year here and then showed how much each year's interest earned. For year one, $1,000 in interest turns into $2,358. It earns another $1,358. All right. So the sum of all this interest on interest ends up being $5,937. Okay, which makes sense. Total earnings were $15,937. So $10,000 earned 10% for 10 years. That's another $10,000. Okay, plus then the interest on interest, $5,937. This interest on interest represents 37.3% of the total earnings. That's a third. Okay, so that's a big chunk there that you earned thanks to compounding in this scenario. To get in a little more detail here, understand compounding a little better, it's related to the time value of money. Okay, and the time value of money essentially says that a dollar today is worth more than a dollar tomorrow. Flipped that on its head, dollar tomorrow is worth more or less than a dollar today. Dollar tomorrow is worth less than a dollar today. Why is that? Okay, well, that's expressed in the compounding example. A dollar today is worth more than a dollar tomorrow because it can be invested, because it can earn a return. Okay, if I can get that dollar from you today, I can invest it and earn a return on it. Conversely, if you don't pay me that dollar, you can invest it, earn a return. That's the core principle in finance, that a dollar today is worth more than a dollar tomorrow. And that's why, because I have an opportunity cost if I don't get that dollar today. okay? Because I can't invest it and make that return I would otherwise make. And another thing to understand about compounding is that it affects both assets and liabilities, all right? So a perfect example of that is credit card. We've got an example for that too. You can see here, we just flipped the amount on its head, okay? Instead of being positive $10,000, it's negative $10,000, all right? So it's money owed. And I increased the interest rate a little bit to make it a little more realistic, to 18%. So what happens here? And obviously, in a real life example, you wouldn't be able to not pay a credit card for 10 years and not have anything happen. There would be repercussions, of course, but this shows how credit card balances can get out of hand because this amount you owe is increasing at 18% per year. And you can see after 10 years, instead of owing $10,000, you owe $52,338. $24,338 of that is from the interest you owe accruing more interest. Okay, it's the same thing we did on this example here, except it's just flipped on its head. You owe it instead of it being accumulated, compounded by you. It compounds what you owe, not what you own. That's how credit cards can essentially spiral out of control. Okay, so to get even a little more technical, and bear with me here, the math's a little advanced, but for the most part, it should be manageable. We're dealing um, with adding, multiplying, and then taking things to the power of, in this case, the number of periods. So anyhow, the formula is future value equals present value times 1 plus the interest rate to the power number of periods. Okay, so it might sound like a lot, but it is pretty simple. Okay, so the future value of your investment is going to be equal to what you invest, the present value, $10,000 in our earlier example. Okay, that's going to be taken times 1.1%, 1 plus 10% to the power of 10. Okay, 1.1 to the power of 10 is 2.5937. So 10,000 times 2.5937 is 25,937. Double check. Yep, that jives with what we had in our example here. So that's good. We've got 3 variables there, in essence, when we try to solve for future value. We've got number of periods, interest rate, and present value. Okay. So what happens when you change those? As you probably expect, an increase in any of those is going to be an increase in future value. So for example, using the previous example, but changing the number of periods. So in this case, we're taking 1.1 to the power of 15 times 10,000. That's equal to 41,772, quite a bit more than our 25,937. We increase the interest rate. Okay, now we're earning 15% instead of 10%. Going back to a 10-year period. Okay, so 1.15 to the power of 10 times 10,000 is going to be 40,456. The greater the present value, as you might expect, the greater the future value. The more you invest now, all things being equal, the more it's going to be worth in the future. That's pretty intuitive, of course, to use kind of the same example. If we invest $15,000 now at 10% for 10 years, that's going to turn into 38,906 instead of the 25,937. Here we've got an example of each and increase in the number of periods. Okay, let's go over to the spreadsheet. So here we go. We went out 15 years. And this kind of illustrates we're doing the same thing here, pulling that $1,000 earned on the initial investment out each year to see what it earns. Well, it's going to be earning money for longer, more periods. So what happens? If we compare this back to our initial example, okay, total earnings were 15,937. Now they're 31,772. That's what 5 extra years got us. Okay, but even let's look at year one. At the year one's interest, that $1,000 earned from year one, that turns into $3,797. Earnings of $2,797. Well, that's quite a bit. That's almost double. Okay, of what it earned over this 9-year period. Okay, so 5 more years, roughly a little over 50% more time, double the earnings. Okay, it's compounding, it's growing more and more each year. The amount of growth at more and more each year. So so not only that, not only is year one's interest growing for 14 years instead of 9, but we look at year 10's interest. Okay, in this example, well, it didn't earn anything because we were done after year 10. Going for a longer period, what happens? Year 10's interest, well, we're not done. Year 10's interest earns $611. Hopefully that illustrates a little bit of what the effects of compounding are. It's kind of a multifaceted effect that and how it helps your investments grow, particularly the greater the amount of time. So total interest on interest, you can see, was 16,772 versus 59,37, considerably more for 5 more years. Okay, and let's look at the other variables here. Interest rate goes up. Okay, interest rate up equals an increase in future value. Again, pretty intuitive, but what's that look like when we play around with it? Well, let's come back to our original example here with the 10% and change it to 15. So we went from total earnings almost double. So again, a 50% increase in interest rate, 10% to 15%, double the earnings. Okay, that's a huge effect. That's an ever increasing effect, right? You can see the other thing we'll note is the total interest on interest for 15%. For 10%, it's 37.3% of all of our earnings. That increase to 15% bumps it up to half of our earnings. Half of our earnings are interest on interest because that interest rate went up to 15%. We go a little further, 25, now we're getting an even bigger chunk. You can see the difference in future value, the difference in earnings. Okay, they go up considerably more. So the greater that interest rate, the bigger the effect. Okay, let's change that back to 10. And look at our final variable, present value. Okay, greater present value, greater future value. More you invest now, of course, the more it's going to be worth in the future. Again, very intuitive. What's that change look like? Okay, so 15,000. Now notice one thing of interest, our percentage of interest on interest is 37.3 in both cases. See, that doesn't change. The amount changes, but the percentage of total earnings that interest on interest represents stays the same. It's because this interest rate stayed the same. Okay, we change this 25,000. Same thing, it stays at 37.3. Okay, the amount we earn off of that initial investment is the same. Total earnings is greater. Total interest on interest is greater, of course, because there's more money in there. You know, I think it's interesting that stays the same because this percentage of interest on interest out of total earnings is based off of interest rate. Last thing we'll consider is compounding periods. This one's getting pretty advanced, so we'll try to conceptualize it as best we can. As the frequency of compounding increases, the future value increases. Okay, all other things being equal. So here's an example of that. We've got our default example, $10,000, interest rate of 10%. The only thing we're changing is we're looking at 1 period rather than 10, okay, to keep things simple. Now with yearly compounding, again, they're gonna in this scenario compound at the end of the year. The future value is $11,000. That makes sense. 10% interest rate on a $10,000 investment. In a year, it's worth $11,000. We've established that. That's pretty simple. Quarterly compounding, what happens? Well, they break this rate up into quarterly amounts and credit it at the end of every quarter. That turns into $11,038. Where did this extra 38 come from? Well, even though our total interest rate is still 10%, the fact that it was compounded 4 times during the year rather than once gave us that little bit of extra return. Okay, because for the same principle that anything else compounds. It's the second time it compounded, there was a little more already in there. Hopefully that makes sense. And then the third time it compounded, whoops, there were the previous 2 quarters interest in there. So there's a little more. That little bit extra resulted in a higher value, even though it was the same annual interest rate of 10%. Okay, so monthly, it's done 12 times, we get even a little extra, $11,047. Here's a look at that, and shows the additional earnings here of $38 additional, $47 additional, that those total earnings. And here's a look at how that changes. See, so if we look at the spreadsheet here, again, getting a little technical, getting into formulas, but in essence, we took C2 is the 10%, we divided it by 4. So it's 1 point, in this case, 0.25, 2.5%. Okay, but the mere fact then that the next time it compounded in Q2, it was compounding on top of $10,250, $250 more. Oh, there's a little extra money. Rather than being another $250, in this case, it was $256. Okay, so hopefully that makes sense. It's a little bit advanced, but the whole point of this is to show how, like I said, to use the example of the snowball, the faster that snowball rolls, turns over, okay, the quicker it's going to grow. All right. That's just, again, a little advanced, but kind of rounds out the concept of compounding. And that's really all I wanted to cover in this video. If you're watching a video like this, you're probably just learning about investing, and that's fine. It's a complicated subject. There are a lot of different facets to it. And so you might check out Simply Investing website with a course, get you on the fast track to learning what you need to learn as far as investing goes. And I'll put a link to that down in the description. Let's cover the questions real quickly here at the end. Again, these are right off of Quora, so some of them are worded logically, others not so much. But so the first question is, how do stocks earn compound interest? Well, again, stocks don't technically earn interest, common stocks anyways. They earn dividends and capital gains. Now, the principle's the same. The return is expressed as an interest rate. How they do that is, like I said, in essence, through capital gains, through the price of the stock appreciating. And the same principle applies. If that $10 stock grows by 10% per year, hopefully you can understand based off of what we've covered here, how, okay, it's worth 11 year 2, and 10% more than that, 10%, and the amount of appreciation at 10% every year goes up, bigger and bigger and bigger. Okay, dividends is the same way. As the company earns more money, grows exponentially, grows at a compounding rate, then dividends should increase at something resembling a compounding rate too. And not only that, if you reinvest those dividends back in the stock, then you're going to own more shares, and your returns on your investment are going to compound also. And that kind of covers the second question: how does compound interest work when investing in stocks? Like I said, it's through the capital gains and through the dividends. Okay, so what is compounding in stocks? Well, compounding in stocks is the same as compounding in anything, in essence, that your returns from this year then earn returns next year, the year after, the year after, the year after. Your returns from next year, okay, earn returns the year after that, and everything. And all those same things apply that we talked about, the variables. Okay, so that's why the longer you hold a stock, the greater you can expect your future value to be. Okay, the greater the interest rate or rate of return on a stock, the greater the future value is going to be. The more shares of a stock you buy now, the greater the present value, the more that the future value of that stock is going to be. So like I said, if you have any other questions, drop them in the comments, and I try to stay on top of that. So if you do that, I should hopefully be able to answer, or somebody else can hopefully address your question. And that is all I've got. And anyhow, hopefully this video helped you understand how compounding can help investments grow, and hopefully kind of understand how stocks can grow too. But again, stocks are the subject, are the focus of the next post, where focus more on capital gains and dividends. Appreciate you watching. Thanks.